Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing a firm's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Affirm provides installment loans for consumers when they buy products. For example, if you go to Amazon and buy a couch for $1,000, at checkout, you can pay using Affirm instead of a credit card. It is possible to pay Affirm monthly installments without paying any interest. Although, if you choose an installment plan greater than 3 months, you have to pay an interest rate up to 30%. They offer payment plans up to 60 months. The interest does not compound like a credit card. Also, Affirm does not charge fees, so there's no penalty for late payments. If you have a $10,000 balance on a credit card, you could pay that balance for 20 years and still not have it paid off. That's because of all the compounding and late fees. In 2017, the company launched a consumer app where customers can apply for a loan with any retailer. The company announced a partnership with Walmart in 2019. Affirm is available to customers in-store and on the Walmart website. The company is on a lot of e-commerce platforms like Shopify, BigCommerce, and Zencart. Affirm is Amazon's exclusive buy now, pay later partner in the US. In May 2021, it acquired another financial technology service company called Returnly. Max Levchin, who co-founded PayPal, is CEO of this company. The company is headquartered in San Francisco, California, and was founded in 2012. The stock trades on the Nasdaq, Deutsche Borse, Mexican Bolsa, and Boerse-Stuttgart. Let's get started with the model. This is a large cap company, 16 billion market cap. They're trading at $56 a share, and they have 281 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have negative free cash flow in 19, 20, and 21. But they had their first positive in the trailing 12 months at $142 million. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's negative each year. Revenue is a sales for the company, and that grows a lot each year from $260 million to almost $1 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. The cost to maintain their platform is part of cost of revenue. Revenue minus cost of revenue gives you your gross profit. That more than tripled from $155 million to $580 million. Below that is their operating expenses. Marketing is part of operating expenses. And below that is their operating income, which is negative each year. Below that is the interest they pay in their debt, which was $59 million, the highest they paid. Below that is other income and expenses. These are all the gains or losses not part of the company's core operations. An example is an asset impairment. Below that is their pre-tax income, then their taxes, and the bottom line of the income statement is their net income, which is negative every year. This is the company's latest income statement from their quarterly report. This is the third quarter of 2020 and the third quarter of 2021. Their revenue from their network was $112 million. It was $99 million last year. $92 million is merchant network revenue, and $19 million is virtual card network revenue. The merchant partners are charged a fee for each transaction on a firm's platform. If somebody goes into a Neiman Marcus store, or they go onto Neiman Marcus's website and they buy something, if that consumer chooses an installment plan with Affirm, then Neiman Marcus pays Affirm a fee. You can go directly to Affirm's app and apply for a debit card. And when the consumer uses that credit card, say at Neiman Marcus, they're charged a fee, and that fee goes to Affirm. Their largest revenue generator is interest income, $117 million. That more than doubled from last year. The interest is charged to the consumer over the term of their loan. They generated $31 million from the gain on the sale of loans and $9 million from servicing income. When a consumer buys something and they apply for a loan, it is possible Affirm does not give that consumer a loan. But most people do receive the loan. Their advance rate is over 90%. And they work with many banks to fulfill these loans. like JP Morgan, Morgan Stanley, MetLife, Citizens Bank. And sometimes they sell loans to a third party, and they have to recognize the gain or loss on that loan they sold. And they recognized a gain of $31 million in the third quarter of 2021. And they received $9.5 million of servicing fees. These are the fees paid by the third-party companies that purchased the loans from Affirm. Most of their revenue is in the US, $262 million, but they do $8 million in Canada, and their Canadian revenue grew a lot more than their US revenue. These are all their operating expenses: $52 million on loan purchase commitments. They posted a $64 million provision for losses, $17 million in funding costs, $25 million in processing and servicing fees, $78 million in technology and data analytics, $64 million in marketing, and $136 million in G&A. Their operating expenses are higher than their revenue, so they have negative operating income. They passed through an expense of $140 million. This loss is related to the acquisition of PayBright. They need to revalue their common stock that was related to the sale price of this acquisition. You could probably ignore this. This is a non-cash item. So that made their net income look even worse. They had a net loss of $300 million. Last year was a net loss of $4 million. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates or loses from its operational business. So you could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. It's a really good sign they generated positive operating cash flow in trailing 12 months. It was negative before that. They don't spend too much in CapEx, $20 to $30 million a year. Most of the CapEx expenditures are for their website and app. Operating cash flow minus CapEx gives you your free cash flow, and they did have positive free cash flow in the trailing 12 months, negative before that. They've been using debt and equity to fund their business. They added $300 million of equity in 2019, $18 million, $1.7 billion, and $1.3 billion. Every time a company adds common stock, it dilutes the current shareholders. It makes your shares less valuable. And it looks like they issue a little more debt than they pay down each year, so they're adding to their debt as well. This is their operating cash flows from their statement of cash flows. This is directly from their 10Q, the third quarter of 2020 and the third quarter of 2021. And the way to calculate operating cash flow, you start with your net loss, that was $306 million. We add back the provision for credit losses, because this is not money they actually paid. You could think of this as money they're putting aside in the event of losses. We add back that $140 million in other income and expenses on the income statement. This was the revaluation of their common stock from that acquisition. And they used a lot of accounts payable, $368 million. So that's a big reason they have operating cash flow in the third quarter, was the use of accounts payable. You'd like to see positive operating cash flows from the adjustments on the income statement, not so much changes in working capital, because this is more of a timing thing. They will have to pay for those accounts payable in the future, and when they do, it'll be a cash outflow in that period. Even without the $368 million, they'd be pretty close to break even. So it looks like they're getting close to the point of becoming profitable. This is their investing and financing sections from their statement of cash flows, the third quarter of 2020, the third quarter of 2021. In their investing section, they spent $1.8 billion from originating loans, and they received $1.5 billion and $200 million from the proceeds from those loans. Those are the proceeds from the bank that are funding the loans. And they purchased $440 million of securities. These are just short-term securities, so they earn a little interest on the cash in their bank. So in their investing section, they had a cash outflow of $629 million. In their financing section, they took on $680 million of debt. They paid down $870 million of debt. It looks like they're securitizing some of their loans because they received $500 million and they paid down $55 million on that securitization. So in their financing section, they had a cash inflow of $244 million. Last year was a cash inflow of $818 million. The reason it was so much higher last year is because they added convertible preferred stock. This is debt that can be converted to equity at a predetermined price. This is the equity section on their 9/30 balance sheet. They have $2.4 billion of equity. They raised $3.6 billion from selling their business, and they lost $1.2 billion from running their business. Let's look at the capital structure. $2.4 billion of equity, $2.2 billion of debt. They're 52% equity, 48% debt. They can pay off a majority of their debt with the cash on their balance sheet. Their debt minus cash is $323 million. And I gave them the lowest whack on Finbox, 7.2%, and that's a discount rate we're going to apply to the future cash flows. We estimated a little over 3 years of future free cash flows. We also estimated a terminal value, which is all cash flows past 2024. That's $16 billion. We discounted those numbers back to today's weighted average cost of capital. We get a value of the company of $14 billion. We divide that by 281 million shares. And we get a calculated stock price of $51. They're trading at $56, so they're trading at a 9% premium. It's a sell according to the model. Their revenue is projected to increase 39%, but I upped that to 50%. I grew their revenue 50% a year until 2024. That's how I got their future revenue estimates. The average company in their industry converts 20% of their revenue to free cash flow. So I multiplied their future revenue estimates by 20%. That's how I got their future free cash flows. 13 analysts priced this stock, and the average price target is 134, the lowest 70, the highest 220. This is from their latest presentation. They haven't provided the 2021 numbers yet. The sales volume they processed in 2020 was 4.6 billion. That's a 77% growth. They have 4.5 million customers and 7,900 merchants. The stock went up about 20% right after the IPO, and then it just crashed the next few months. And from that point, the stock price was really driven up to about 175. But currently it's trading almost at its all-time low, so it's trading at a great value if you like this company. But this could be a really volatile stock, so it could be a bumpy ride. The stock has gone down 49% in the past 52 weeks, while the S&P is up 14%. The 52-week low is 47, the high is 177. And the stock is trading well below its 50-day and 200-day moving average. This is a pretty popular stock. Over 10 million shares are traded each day. 70% of the shares are held by institutions, and almost 6% of the shares are shorted. Their employee count has doubled in the past year. They currently employ 1,900 people. If you invested $10,000 when this company IPO'd, your investment will be cut in half today, about $5,000. In the past year, there's only been insiders selling, no buying. These are the 4 insiders that have sold the stock, the number of shares, and the sale price. I'm sure these 2 people are really happy selling around $150. 46% of the shares are held by institutions, 23% by the general public, 11.5% by private companies, 7% by insiders, 7% by public companies, and 5% by venture capital and private equity firms. The biggest shareholder is Jasmine Ventures at 8%, then Shopify. They probably work together a lot, so they gave Shopify some common stock. They own 7% of the company. The CEO of the company owns 6%, almost $1 billion. Bailey Gifford 5.8% and Capital Research 5.2%. Let's look at their financial ratios. We can't look at the PE since they have negative net income. They have a high price to sales of 16, that's stock price over sales per share. So investors are paying $16 for $1 revenue. The median in the market's 3, the average is 9.5. Price to book is 6.6. The only reason it's that good is because they raised a lot of cash from all their equity offerings. They can easily cover their current liabilities with their current assets. They have a current ratio of 9.1. Let's look at their assets on their 9/30 balance sheet. 1.4 billion of cash, 236 million restricted cash. Restricted cash is cash that's set aside for a specific purpose, like to buy a factory or to buy another company. 456 million of securities available for sale. This could be common stock in another company, or probably something less risky like T-bonds. I just looked on their quarterly report. It's CDs, corporate bonds, commercial paper, and government bonds. They have 2.2 billion of loans, 100 million of accounts receivables. This is how much money other companies owe this company. 85 million of property, equipment, and software. 541 million of goodwill. Goodwill is the premium you pay when you acquire another company. It's the acquisition price minus net assets. 71 million of other intangibles, 207 million of commercial agreements, and 170 million of other. Let's look at their liabilities. 426 million of accounts payable. This is how much money this company owes other companies. 450 million of accrued expenses. 1.6 billion of securitization notes, and 484 million of debt. These two are related to the loans they provide their customers. They generated $142 million of free cash flow in the trailing 12 months, and they have nearly $4 billion of working capital. So it looks like the company does have enough funding to get through the next 12 months without taking on any debt or equity. The best way to look at ratios to compare them to companies in the same industry. There are 117 companies in the same industry as Affirm, and these are the top 20 by market cap. And Affirm spends less than average in CapEx. They have a better debt to equity ratio than the average. They do have positive free cash flow, but it is smaller than average. Their market cap is $16 billion, which ranks 20th out of the 117 companies. They do have a good price to book, but they're worse in price to earnings, price to free cash flow, and price to sales. They generate about $1 billion of revenue, which is less than average of $3.6 billion. And they have a negative ROA and ROE. So to summarize, I have them trading at a 9% premium. And I do really like what this company does, because credit cards can really kill people with all the compound interest. But they're competing pretty much head on with credit cards, which is not going to be an easy fight. But as long as they can keep building relationships with merchants, then I think they have a fighting chance. I rank their free cash flow as 5 out of 10, their revenue 8 out of 10, and their ratio is 2 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.